At the close on July 17th, all three major US equity indices ended lower. The Dow Jones Industrial Average fell 0.59% to 51,839. The S&P 500 declined 0.19% to 7,443, and the Nasdaq Composite slipped 0.05% to 25,508. At the index level, the declines were modest, but what we need to pay attention to is the structure beneath the indices. Large cap tech stocks showed divergence. Microsoft rose 2.15% to $402, leading the Dow components. Google gained 1.52%, and Amazon rose 1.12%. Apple fell more than 2%, while Tesla dropped nearly 3%. Energy stocks all moved higher. Chevron gained 1.23%, ExxonMobil rose 0.71%, and Brent crude climbed to $89. Chinese ADRs stood out. The Nasdaq Golden Dragon China Index rose 0.90%. Alibaba surged 4.69%, and JD.com gained 3.31%. Chip stocks attempted a rebound. The Philadelphia Semiconductor Index rose more than 3% intraday before pairing gains to close up 0.6%. SK Hynix ADRs still fell nearly 2%. This picture closely matches the framework we discussed a week ago. At that time, we judged that AI technology stocks were undergoing valuation derating, and capital was rotating from growth assets built on stories toward assets with cash flow, inelastic demand, and pricing power. 1 week later, this judgment is being validated by the market one item at a time. Next, let's review the performance of the 5 stocks one by one and examine which judgments were confirmed and which may need revision. 1. Alibaba, the catalyst has landed and the market has given positive feedback. Our assessment a week ago was that fundamental catalysts were strengthening. Apple Intelligence had been approved for launch in China, with Qwen set to participate in the Chinese version of Apple's AI features. Honor had announced a partnership with Alibaba Qwen to develop mobile AI agents. However, the price had already reacted to some extent, so waiting for a pullback was more appropriate than chasing the rally. On July 17th, Alibaba closed at $120.34, up about 4.7% on the day. The intraday high reached $121.86, and the intraday low was $117.88. This price action validated 2 judgments. First, the catalyst is indeed effective. The market's positive reaction to the launch of Apple Intelligence in China is real. As the core AI capability integrator, Alibaba Qwen directly benefits from this development. The Nasdaq Golden Dragon China Index closed up 0.90%, with Chinese ADRs broadly stronger. Second, the risk of chasing the rally still exists. The first observation zone we defined a week ago was $117 to $119, and the main accumulation zone was $113 to $116. On July 17th, the intraday low reached $117.88, falling exactly into the first observation zone. Anyone who chased above $121 would have been trapped that same day. The closing price of $120.34 shows that the market is still in the process of pricing in this event, and the process has not yet been completed. The current MA5 is about $116.6, and the MA10 is about $112.6. The price remains above both moving averages, meaning the short-term trend has not been broken. 2. Microsoft, the best structured name, is delivering. Our assessment a week ago was that Microsoft was the best structured among the 5 stocks, but it was not appropriate to go full position before the July 29th earnings report. The core logic was that Azure's AI infrastructure was not contracting. Instead, it was expanding its sources of chips and hardware. The main risk was not insufficient demand, but excessive capital expenditure and short-term pressure on free cash flow. On July 17th, Microsoft closed at $402.29, up 2.15%, with turnover of $11.111 billion. The intraday low was $389.67, and the intraday high was $403.18. This price action also validated our judgment. First, the judgment that Microsoft was the best structured name holds. In an environment where all 3 major indices closed lower, Microsoft led the Dow components. This shows that the market still recognizes the long-term logic of Microsoft's Azure business and AI infrastructure. On July 17th, Microsoft announced that AMD's Helios platform, MI455X, and next-generation EPYC processors would be introduced into Azure. This news itself does not constitute a short-term catalyst, but it tells the market that Azure's AI infrastructure is still expanding and that there is no problem on the demand side. Second, the judgment that it was not appropriate to go full position before earnings was also correct. On July 17th, the intraday low was $389.67, falling exactly into the main accumulation zone we defined a week ago at $389 to $393. If a light position had already been taken at $396 to $399, the second tranche could have been added in the $389 to $393 range that day. The judgment that $390 to $399 is currently the highest quality entry band among the 5 stocks has now been validated by the market. The key variable going forward is the July 29th earnings report. Azure growth, AI capital expenditure, and free cash flow are all indispensable. 3. Eaton, strong industrial logic, but valuation still needs earnings validation. Our assessment a week ago was that Eaton had the strongest industrial logic. Electrical America's orders grew 42% on a rolling basis, and electrical backlog increased 48%. However, the current forward PE was around 29 times, and the market had already paid a relatively high premium for AI data centers and liquid cooling. The truly attractive zone was $382 to $390, not the current $401. On July 17th, Eaton closed at $401.41, with an intraday low of $399.27 and an intraday high of $413.46. It opened at $408.21 and closed at $401.41, a typical open high, close low pattern. This price action continues to validate the zone-based judgment framework. First, $401 is indeed not an ideal main accumulation price. The stock opened at $408 and then moved lower to $399. Anyone who chased the high was trapped. If a light observation position had been taken at $395 to $400, it would currently still be at a small loss or roughly break even. Second, the May accumulation zone of $382 to $390 has not yet been reached. This means the market has not yet offered a better risk-reward ratio. Eaton will release its Q2 earnings on July 31st. If orders and backlog remain strong, but margins or integration costs fall short of expectations in the short term, the $382 to $390 zone could become a reality. Third, the industrial logic has not been broken. The intraday low of $399.27 was still above the lower bound of the first observation zone we defined a week ago at $395. This shows that the market still has willingness to support Eaton's electrification and data center logic. 4. Rockwell, the name with the weakest margin of safety, is still searching for a bottom. Our assessment a week ago was that the industrial AI logic was valid, but free cash flow did not grow in tandem during the first half of the year, and the valuation margin of safety was the weakest. The current price of $458 was not yet an ideal main accumulation price. It would be more appropriate to wait for $440 to $455, or for confirmation that the stock can reclaim $472. On July 17th, Rockwell closed at $458.71, with an intraday low of $456.38 and an intraday high of $466.48. This price action validated the judgment that Rockwell had the weakest margin of safety. First, $458 indeed lacks appeal. The closing price of $458.71 was slightly above the lower bound of the first observation zone we defined a week ago at $450. The price remains below all short-term moving averages. Citi analysts raised their price target from $500 to $555 while maintaining a buy rating. This provides support for the long-term thesis, but the short-term price structure has not yet been repaired. Second, the main accumulation zone of $440 to $455 has not yet been reached. Similar to Eaton, the market has not yet offered a better price. If the logic of recovering industrial automation demand continues to hold, $440 to $455 will become a zone worth watching. But if orders weaken or free cash flow continues to deteriorate, this zone will also need to be reassessed. 5. Chubb. Earnings are the real dividing line. Our assessment a week ago was that Chubb was not a price problem, but a timing problem. Wait for tonight's earnings report after the July 21st close before deciding whether $346 to $352 truly becomes a buy zone. The core logic was its excellent combined ratio of 84%, but insurers' risks often only become visible in earnings reports. On July 17th, Chubb closed at $352.53, with an intraday low of $351.03 and an intraday high of $354.64. It opened at $352.27 and closed at $352.53. The price was almost unchanged, with the market staying on the sidelines before earnings. This price action itself validates a judgment to wait for earnings. The market made no directional choice before the report, indicating that everyone was waiting for the numbers after the July 21st close. The three scenarios during the waiting period still apply. If the combined ratio remains clearly below 90% and reserves are stable, $346 to $352 can be used to establish the first tranche. If the combined ratio rises above 90% or adverse reserve development appears, then even if the stock drops to $336 to $343, one should not buy mechanically. Summary: the framework has been validated, but execution requires discipline. Looking back at the week's price action, the overall direction of our judgment framework has been correct. The market is indeed shifting from buying stories to buying cash flow, inelastic demand, and real pricing power. Microsoft rose 2.15%, Alibaba gained 4.7%, energy stocks all moved higher, and chip stocks faded after an intraday rally. These phenomena point in the same direction. Capital is searching for a new pricing anchor rather than simply leaving the market. The entry zone judgments for the 5 stocks have mostly been validated. Microsoft found support in the $389 to $393 range. Alibaba offered an observation window at $117 to $119. Eaton and Rockwell have not yet reached their main accumulation zones, but have not broken down. Chubb remained quiet before earnings while waiting for direction. But validating a framework does not mean automatic profits. Entry zones are conditional. Enter the zone, then observe the close for confirmation, not buy as soon as the price touches the level. The July 17th price action once again shows that an intraday spike or dip does not count as a valid breakout or breakdown. Eaton opened at $408, surged to $413, and then fell back to $399. Anyone who chased the high was trapped that same day. If Alibaba was bought above $121, it would also have been sitting on a loss at the $120 close. The path ahead remains clear. Chubb earnings on July 21st, Microsoft earnings on July 29th, Eaton earnings on July 31st, and the follow-through of Alibaba's AI partnerships. Each of these is a node for testing our judgment, not a reason to celebrate in advance. The framework being validated does not mean the operation is complete. The value of a framework lies in providing discipline, and the value of discipline lies in this. When the price enters the predetermined zone, you know what to do. When it does not enter the zone, you know what not to do. Please subscribe our channel. We will continue to share our market observations and analysis here, and we look forward to your engagement.